So what did we talk about last time? Worksheet. That's correct. We learned how to prepare a worksheet. And we finished this slide where we talked about accounting cycle. We talked about the accounting cycle and how part of the accounting cycle is done almost on a daily basis. This is when, for example, companies journalize and post. They analyze the transaction, they journalize it, post it to the ledgers, and then we talked about monthly activities or quarterly activities where, for example, the company might prepare the trial balance, they make adjustments, they journalize, basically they journalize those adjustments and post them to the ledger, and then they prepare an adjusted trial balance. And then we talked about the preparation of financial statements. We learned how to use a worksheet to prepare the financial statements, right? And then said that the last two are usually done after, basically they are done annually. Those are the closing entries. They are done only at the end of the year. Any questions? Okay. Now, they will talk about correcting entries. Are you guys all okay with what we talked about last time, about the worksheet and everything? Excellent. Now, the correcting entries, for the correcting entries, when do we need to do that? Correcting entries are different from adjusting entries. You have to keep that in mind. Correcting entries are those are actually those entries that companies make to fix a mistake, to correct certain mistake. And this is not the same as adjustment. Adjustment, you are actually adjusting. There was no mistake done, but you're simply recognizing a certain event, like a revenue or an expense. That's not the same thing here. And while with adjusting entries, we only make adjusting entries at the end of the month, for example, or at the end of the accounting period, this kind of entries, correcting entries, are to be made as soon as the mistake is discovered. Do you remember in chapter 2 when we did part, I think it was in chapter 2, where we had those certain journal, basically, when we talked about the trial balance and how it can sometimes balance despite the existence of certain mistakes. Do you remember that? For instance, you can, a purchase of supplies on account, which is supposed to affect accounts payable, you might record it as cash, right? As credit to cash. While the balance between total debits and total credits will be the same, basically, so the balances are equal. In other words, the trial balance will not identify that. The companies later on, when they make the payment, when they have to make the payment to the client, they say, okay, so we said that we paid it, but we did not. So we have to pay. Then they understand that they made a mistake, and they have to go back and fix it. They fix it as soon as they can. Remember, we tried that in class. What did we do? We said that the easiest way is actually to reverse it, the incorrect one, and to re-enter the new one, right? You remember we did that in class. Now, this is one way. Another way is to simply directly do it, and we did it actually in both ways at that day. We tried to just enter the correcting entry directly. There are different scenarios where this happens. It's important to understand that these correcting entries must be done before closing. Once you do the closing entries, this is done. You're finished. You're turning a new leaf. You're burning your excess stuff. You cannot go back and say, no, I want this back. You can't. You burned it. But just be careful not to get like a fine for a fire hazard, something like that, or you don't burn down the whole house. In this case, it's the whole company. You have to be careful when you do that. You have to do the correcting entries before you close the books. Now, let's look at these two scenarios. So this one here we have on May 10th, Mercato Company journalized and posted a $50 cash collection on account. What do you mean by cash collection on account? Sorry? Lauren? Accounts receivable and cash. So what's happening here? So this is accounting talk for the company collected a debt from their customer. Their customer paid them. So this is basically they posted a $50 cash collection on account. So the accounts that were supposed to be involved are cash and accounts receivable. From customer as a debit to cash, that's correct. Our cash has increased, so we're supposed to debit cash. And a credit to service revenue. That's a mistake. Why is that? Yes.
Because the service revenue was already earned previously on account.
Exactly. The service revenue was already recognized in the past, and the company did not pay, so we had, at that time, we had debited accounts receivable. Now we are simply collecting a debt. The company is simply getting their money from their customer. So this one is wrong. We're not supposed to do this. This is what we're supposed to do, cash and accounts receivable. Now, the incorrect entry was a debit to cash and a credit to service revenue. First thing to do, you need to write the correct one. What are you supposed to do? What was the original entry? The correct entry. The correct entry would be a debit to cash and a credit to accounts receivable. That's the correct one. Now this is where you can actually use the T accounts. So what accounts do we have here on the screen? We have 3 accounts. What are these accounts? Cash, revenue, accounts receivable. Am I correct? What are the end balances that we are supposed to have? For cash, from this one here, just from this transaction, what's supposed to be the debit to cash? We can do it in a different way. So the incorrect one, and I'm going to use the red color for the incorrect one, okay? So the incorrect one was 50, and service revenue was credited 50. The correct one is going to be in green. It's supposed to be 50 and a credit to accounts receivable 50. How do we get from the red to green? That's the correcting entry. How do we get from this one? Do you need to do anything for cash? So cash is not involved. What do we need? We need to decrease revenues to make it 0. Because revenue is supposed to be 0. How do you make it 0? Yes. Exactly. So the green one, the blue one is supposed to be here, is a debit, so that the balance will be 0. And a credit to accounts receivable, so that the balance will be 50. So the balance should be here 50 and 50 on this side. Remember, this is not an addition. That's the correct. This one is the incorrect. So the red is correct, incorrect. The green is correct. So what did we have to do here? We know that cash was correctly debited, so it should not be affected. We know that service revenue was credited $50. We should not have done that, so we have to put it back. How do you add it back? By reversing it. How do you reverse it? How do you reverse a credit to revenue? You debit revenue. And then you introduce accounts receivable. Accounts receivable did not have any, it was not included in the original entry. So the correcting entry would be eventually a debit to service revenue and a credit to accounts receivable. Anyone has a question about this? You will have questions like that in the exam. Please prepare the journal, the correct journal entry, etc. Now this is one way to do it. There's another way. Here we just went directly from the incorrect to the correct by writing the journal entry. There's another way, which is a two-step method. How do you do that? You completely reverse the first one, and then you re-enter the correct one. Okay? How do you reverse the incorrect one? Yes? Exactly. So the other way would be here to have, for example, you have cash. It was debited 50, and and revenue was credited 50. That's the incorrect one. So to reverse it, we simply won't use purple here. We credit and we debit. Now we need to enter the correct one. What's the correct one? The correct one is supposed to be a debit to cash and a credit to accounts receivable. Right? Now let's do the balances. What's the balance for this one? It's 100 minus 50. So it is 50. What's the balance for revenues? 0. What's the balance for accounts receivable? Credit of 50. In this case, this is what you need to do. This one and this one. You debit cash, etc. So what did we have to do? This is the correct one. Okay? So in this case, what was the correcting entry? We did it in two ways. This is how you actually can calculate. You reverse it and then you re-enter the correct one. Then you look at what changed. Okay? You get to the same balance. You get to eventually to the correct one, which is 50 for cash and 50 for accounts receivable. What you actually ended up doing is this one and this one. That would be the same as the correcting entry here. Yes, please.
Which one is more popular?
I think it's personal preference.
Do you think that's easier, the reversing?
I personally prefer the reversing one for a reason. It becomes, and this is from a basically selfish reasons. For my research, it's easier when I have a transaction and it's reversal, because I can easily identify it. Whereas when you have the correcting entry, it's not as easy to detect it immediately. So this is from a research perspective. Companies, a lot of companies, they just do the correcting entry because it's just one step rather than two steps. So with the way that, like when you have it as reversing the entry and then the correcting entry, you are making two entries. With the correcting entry, you're just making this one. So this is the only one that we will make. You don't make the correct one. It's automatic, you will automatically reach it. So when you have just the one step correcting entry without reversing, you're actually only making one entry. That will be the correcting entry. On the other hand, if you use this method here, you have two entries. The first one is to reverse it. The second one is to enter the correct one. Now, in the homework, you might be asked to basically calculate basically what's the amount for the correcting entry, etc. Or like what will be the correct balance But in certain cases, they might ask you for the correcting entry, in which case you will have to learn how to do the correcting entry. You can actually, one way to do it, if you're fast with it, you can do both ways, and then you can check to see if you got the same results. That would be more or less like a verification for you. Now, in the exam, you might not have that luxury, but for the homework, you do have time, so why not do that? That will make it actually, would allow you to learn both methods, and at the same time, it will make it easier to verify that you got the right answer. So the first scenario, what we had was we had the wrong account. So the wrong account was involved. In the second one, we actually have the same account, but the wrong amount. So the previous one we had same amount, the correct amount, the wrong accounts. Here we have the wrong amount, correct accounts. So here Mercato purchase on account, equipment costing $450. Purchase on account, purchase equipment on account. What accounts are involved? Equipment and purchase and accounts payable. This is what the company expects to pay. So we have equipment and accounts payable. Now the company recorded that as a purchase, as a debit to equipment for 45 and a credit to accounts payable for 45 instead of 450. The correct one would be what? That's the correct one. It's supposed to be what?
450.
Sorry? 450. It's supposed to be a debit to equipment for 450 and a credit to accounts payable 450. That's easy. How do you get from this one to this one? Yes?
You would take the difference of the amounts.
Irfan, right?
Imran.
Imran, I'm sorry.
Yeah, no.
Yes.
You would take the difference of the amounts, so in this case 450 minus 45,
Exactly.
and then you would write it in the correcting entry.
Exactly. So basically what we have here, what Imran says is that you basically look at the difference between the two and you debit it to the debit account, you credit it to the credit account. We have equipment, it's debited 45, it's supposed to be debited 450. What's the amount that you need to put here as correcting entry? 405 on the debit side. And now we'll do the same thing for accounts payable. It was a credit of 45, the correct one is 450. Now we have here, again, it's supposed to be, okay, 405. And that will be the correcting entry. The correcting entry in this case is a debit to equipment, 405, and credit to accounts payable, 405. The other way was simply to reverse the incorrect. So basically at that time what you would do, you would credit equipment. So the other way would be to credit equipment, 45, and debit accounts payable, 45. That would be the reversing. And then you enter the correct one, which would be debit equipment, 450, credit accounts payable, 450. The ending result will be the same thing. So when you have the option, pick whichever one you feel more comfortable with. When you don't, if they ask you specifically to do it one way or the other, stick to what they tell you. Any questions about this? Okay. Now we will talk about the classified balance sheet. So the classified balance sheet is simply an even more organized way to presenting and grouping assets, accounts, and liabilities and stockholders' equity accounts. So basically, instead of saying that, okay, instead of dumping all your accounts in one place, and when you have only 2-3 kinds, it's okay, but when you have plenty of accounts, makes it a little bit more, it makes it a little bit more messy. So it becomes messier in a way. To avoid doing that, companies, they organize their balance sheet in, and this is what they call classified balance sheet, by grouping similar assets together. For instance, we have current assets. What do we mean by current assets? Current assets are the assets that the company expects to either expects to convert to cash or to use within 1 year. Can I give an example of current assets? Cash. What can we convert to cash faster than cash itself? Cash. What else? Again, this does not mean that this is going to happen 100%, but this is the expectation. The merits? Yes, sure. Inventory, merchandise. The company would expect to sell their products within 1 year. Okay? So current assets are assets that the company expects to turn or into cash or to use within 1 year, or the basically their operating cycle, whichever is longer. We'll talk about that in a second. Okay? So equipment, yes. The equipment, well, this is a tricky thing. Equipment, if you're talking about equipment like machinery, you expect to use it in 1 year. And by use it, I mean, maybe I did not clarify what I said. By using it, what we mean is use it completely. So part of equipment, which is going to be maybe disposed of later on, something like that, but usually equipment is under property, plant, and equipment. It has a different thing because it has also, you have to deal with depreciation and stuff like that. So current assets does not include equipment. It includes supplies, so which is sometimes similar to basically when we think about it, but accounting for it is different. So you have, in this case, equipment will fall under property, plant, and equipment, which would be like the building, because it's treated in the same way as the equipment. You would expect a truck to serve you many years. Same thing as a building. Hopefully, it's not going to fall on our heads, right? So we hope that this building, at least while we're in it, is going to hold. You expect it to serve you for several years. It has a long, useful life. And this one is treated similarly, right? Now, current assets would also include, for example, accounts receivable. This is whatever the company sells to their customers and they expect to pay them back within 2 months, for example. Those are current assets. You have another type is like long-term investments. Long-term investments is when the company invests in, for example, bonds. This is where Best Buy invests in bonds from the company that Apple actually issues. So it's not their own bonds. There's securities, etc. of other companies. This is called an investment. And I'm not going to talk a lot about this because we have a whole chapter about this. Intangible assets. Can I give an example of intangible assets? Yes. Patents, yes. So those are assets that do not have, they do have value. Patents, they have money. You earn money from them, so they are assets, they are resources that you make money out of. You can sell them, but they don't have a physical form. Thanks, Matthew. So this is basically what intangible assets mean. They are not tangible. They are not something that you can touch. Can you give another example, Laura? You cannot say that employee talent is an asset simply because you cannot own an employee. It's not anymore. But you cannot you consider that as an asset. Those are people. They have talents. You cannot actually take that. Although it does have, it will be included in a different thing, but it's not by itself an intangible asset. Remember that assets are resources that the company owns. This is what you need to think about. Yes?
Intellectual property?
Intellectual property.
Or like a brand name?
Brand name. For example, if you want to put the M of McDonald's, you have to pay money for it. Right? You have to pay to, if you want to use a franchise. All these things. Any questions? Also, companies, they want to, so you see, companies also want to know, or people would like to know about companies' current liabilities. Current liabilities, they are the other side of the story when it comes to current assets. Those are the liabilities or the debts that the company is supposed to pay within 1 year or one operating cycle, whichever is long. So it's, as far as you are concerned, unless otherwise stated, companies always think of current liabilities within 1 year and current assets within 1 year. Now, the importance, a lot of companies actually look at also the relationship between current assets and current liabilities. What does current asset give you, tell you? Yes.
Money that you owe.
No, current, did I ask about current assets or liabilities?
The liabilities are money that.
Okay, so the liabilities are money that you need to pay within 1 year. And how can you come up with that money? From your current assets. So basically, how can you pay for your employees? So the relationship between current assets, if you have more current assets than current liabilities, it means simply that within this coming year, you will be able to pay your short-term debts. You can pay your employees, you can pay your accounts payable, etc. Your tax payable, and all these things. Right? If you have less current assets than current liabilities, then you are in problem, and you have a problem. How are you going to pay these people? So it will be more alarming at this point. Okay? So let's do that one by one. This is how it looks like. As you can see, it's a little bit more detailed here. So you have, this is the classified balance sheet. You have the same thing on the top. You have the company's name, you have the statement name, and you have the date. This is balance sheet, so it is as of a specific date. This is the snapshot. It's not for a certain period, it's for a certain day. So on December 31st, this is what company had. Those are the balances of the accounts that the company had. Now, as you can see, the company will list them in order of liquidity. What do we mean by order of liquidity? For current assets. So you always start with current assets, long-term investments, PP&E, and then you have intangible assets. So, for example, when you talk about current assets, they are always listed in the form in the order of liquidity. What do we mean by that? Yes.
How fast it can be turned to cash?
That's correct. How fast can you convert them to cash? So the first thing is cash. Needless to say. Next, usually are debt investments. Those are short-term, basically investments in bonds, and usually municipal bonds. Something that you can immediately sell, and you can convert that into cash immediately. You want to sell your bond, the bonds that you own, go ahead on the market and sell them. And then you have receivables, like notes receivable and accounts receivable, etc. Then inventory. Inventory comes after the receivables. Why is that? Because inventory, those are the products that you have in your storeroom. Okay? So you need to sell them first, then they become receivables, and then you try to convert them. So which one is faster to convert to cash? Receivables, etc., etc. On the other hand, we have also liabilities and stockholders equity. Oh, by the way, as you can see here, you have long-term investments. Those could be stocks, etc., that the company has invested in other companies' stocks and in other companies' bonds, etc. Sometimes there's one thing: investments in buildings. So if I tell you that the company purchased a building, does it go under long-term investments or property, plant, and equipment? Yes. Exactly. That's correct. So basically, it depends on the use. Is the company going to use a building to run their business and to run their business operations? If the company is going to use them for their business operations, it will go under property, plant, and equipment. They are using it. If the company buys the building later on, strictly so that they will sell it later on, they buy it as an investment, then it's an investment. It's the same asset. This is why in accounting you have to use your judgment. Basically, are you going to use it to run your operations? If yes, then it goes under PPE. If no, it will go directly under long-term investments. Okay? Now, on the other hand, we have liabilities and stockholders' equity. Once again, the company would record them in the form of current liabilities, long-term liabilities. They usually basically have those two main classifications. In companies, they usually include different details about each part. Like, for example, with depreciation for assets, they have to also, they explain when it comes to liabilities, what kind of liabilities they have in specific, sometimes in the notes, sometimes in the actual statement. And of course, under stockholders' equity, we always have common stock, which is also sometimes called capital stock. And we have retained earnings. So when you hear capital stock, that's common stock for now. Okay? So current assets, we talked about that. This is what the company expects to convert into cash within 1 year or one operating cycle. Now, certain companies, they have operating cycles that is longer than 1 year. Most companies do not have this, but some do. Like, for example, Boeing, companies that manufacture airplanes. In order for them to gather the raw material, manufacture the plane, put it all together, sell it, and collect cash, collect the money, it takes more than 1 year, because it takes a long time to build the plane. Okay? So as a result, their operating cycle is longer than 1 year. Generally speaking, other companies, they are faster. They produce the things, their products faster. So as far as you are concerned, you always consider current assets are the assets that will be converted to cash within, or expected to be converted to cash within 1 year, unless otherwise stated. Okay? Like I said, this is important. People like are interested, investors, creditors, they are interested in looking at this at current assets because it will tell them, it will give them information on the ability of the company to pay their short-term debts. Okay? So can they meet, and this is called actually the liquidity of the company. If the company has more current assets than current liabilities, it means they can actually pay their debts in the upcoming year. Okay? And again, they are listed in the order of liquidity, which is to mean in order they are expected to be converted to cash. Long-term investments. Those are the investments in other companies' bonds, or other, let's say, municipal bonds. Okay? It depends basically on the maturity date. So you see, part of those long-term investments, if they are coming to maturity now, they change nature. Same thing with liabilities, actually. So if you have a long-term debt, however, it will mature this year. Remember the notes payable? If it's a notes payable for 5 years, however, it's coming to maturity this year, then it becomes a current liability. Again, we will talk about these in the future. So I'm not going to, this is here to just introduce you to the account and basically what we mean by classified balance sheet. Not how to, we're not going to go into detail about this at this point. Property, plant, and equipment, those are lands, machinery, equipment, buildings, etc. And those are the items that depreciate, with the exception of land. Land, by the way, never depreciates. But the others, you have you have to take into consideration depreciation, which is the allocation of cost. Remember that. It's not evaluation, it's the just allocation of the cost of this asset. Those assets are expected to be recorded at cost, following the historical cost principle. Okay? And some people also call them like fixed assets, planned assets, etc. So you would have here, for example, you have the account and then you have less accumulated depreciation. And certain companies, they just include one amount for accumulated depreciation. Others, they have more detailed information. It all depends on the company and the size of the company. If the company has too many accounts or it has just one account, something like that. Okay? Intangible assets, those are, like intellectual property, those are assets that do not have a physical substance. Okay, they are not physically existent. Intellectual property, brand name, franchise, all these are intangible assets. Goodwill is where, this is a little bit trickier. Goodwill is usually, you cannot calculate it or evaluate it until the business is sold to another company or something like that. That will be usually the difference between the actual cost and the book value. But we'll talk about that in the future. So in this case, as far as you are concerned, goodwill, intellectual property, patents, royalties, franchises, brand names, trademarks, all these are types of intangible assets. Nice. Okay, so yes, when you talk about cash and stuff that are sold or consumed within 1 year, those are current assets. Okay? You do deserve here a smiley face. Yes, you did. You got like 95%. This is good. Encourage you. Actually, I'm also going to draw you a star. It's a messed up one, but it's a good one, right? Thanks. See, this is how you can be nice to me. And then in that case, I will give you easier exams next week. That's another one? Yes, that's another one. Don't disappoint me now. Okay. I'll give you a smiley face here, but you don't deserve a star. Sorry for that. That was just for one of them. So yes, when you talk about the order, usually you put them in the order they are expected to be converted to cash in order of liquidity. Okay, you know that one. It's intangible assets. Okay, why did you not do it? I'll still give you a smiley face. Are you happy now? Okay, I know that you guys knew the answer. This is why I didn't ask you for it. Now, Baxter Hoffman recently received the following information related to the company's balance sheet. What you need to do is to prepare the assets section of the classified balance sheet. So which one do you start with? Cash. Always with cash. Bless you. Next. And then, so we have cash, accounts receivable. Next is inventory and prepaid insurance. Okay. So that will give you the total for current assets. Next, you have property, plant, and equipment. What do we have? We did this one and we did this one. Property, plant, and equipment. Oh, yeah, 2 accounts. Come on. And come on, you have 2 accounts. You know that usually equipment comes before accumulated equipment. See, now you got me all speechless. Which is hard to do. Talk a lot apparently. So it's equipment, less accumulated depreciation per equity. See, that's not complicated. Just have to follow this procedure and then you will be able to classify it correctly. Current liabilities, again, this one, it simply talks about, those are the debts that the company expects to pay within 1 year. Okay? For example, who can give an example of current liabilities? Good. Actually, Lauren, ladies first, right? You should have said, let her say first. You see, I told you I talked a lot, yes. Accounts payable. Notes payable, yes. So basically, salaries and wages payable, those are expected to be paid within 1 year. Now, notes payable, there are certain notes payable that are longer than 1 year. So let's call them short-term notes payable. Those are the notes payable that are expected to be paid within 1 year. Okay? So, in this case, usually, the first one to this is notes payable. The reason why you include it is that it has the strongest claim over the company's assets. This is a formal document that would, basically this is a formal document signed that would indicate this debt. Okay? And then after that, accounts payable, and after that, it's in order of magnitude. Order of magnitude, it means how big it is. Okay? So for example, let's look at this example here. You always have notes payable first, and then accounts payable. After that, you have them in order of magnitude. So in decreasing order of amount, basically. Yes?
So depending on the month, let's say that it varies, would you reorder that based on magnitude?
Yes.
So every month it could be different.
Usually those financial statements are prepared at the end of the year. So they are done one time. But in certain cases, they are also prepared in quarterly, actually. And at that time, yes, you always reorder. So let's say every time you prepare the financial statement. Every time you prepare the financial statement, you look you show them in decreasing order, with the exception of notes payable and accounts payable. Oh, my bad. Okay? And this is basically when we talk about current maturities of long-term debts, this can be confusing. Those are debts that are supposed to be, for example, for 10 years or 15 years. However, they are maturing this year. So you will have to pay back the amount this year. That's why we call them current maturities of long-term debts. Okay? Long-term liabilities are, again, long-term debts. And you have sometimes deferred income taxes, etc. So in this case, as far as you are concerned, just understand that those are debts that go beyond 1 year. You are not, basically they are not to be paid within this next year. Yes?
Sorry, can you explain the current maturities again?
Current maturities are, for example, let's say that you had a 5-year note payable. You remember that when we said that the principal will be paid when it matures, right? Only at maturity. You are going to pay back the debt on that day. On that day, let's say that this day is next month. So it's current because you expect to pay it within this month. So originally, when you originally signed the loan, when you took the loan, it was a long-term loan. But now it's coming to maturity. Coming to maturity, it means that now you will have to pay it. Because you have to pay it within this year, it becomes automatically current liability. Stockholders equity. Again, stockholders equity usually when you have when it's a proprietorship, you have just one capital account because it's for the owner. When it's a partnership, you have one capital account per partner, basically saying that how much each partner contributed to that to that company. And when we have the corporation, we have common stock. Later on, we will learn about other. Basically, we have common stock and retained earnings, of course. But later on, we will learn about other types of stocks. For now, you have common stock and retained earnings. Common stock is also sometimes referred to as capital stock. Usually here, for example, you would have common stock, and they tell you how many the number of shares that the company issued. and the number of shares that they are out there in the stock market, owned by other people. I don't want you to worry about this for now. Okay? For now, what you need to understand is that the company, if it is a corporation, the company would have common stock and retained earnings. So, which of the following is not a long-term liability? Don't you dare get this one wrong. So we're looking for not a long-term liability. I believe that this one would be a big hint. It says current. Come on, guys. No smiley face for you guys. I'm sorry. So the following accounts were taken from the financial statements of Callahan Company, and we need to classify them as basically as current assets, current liabilities, long-term investments, etc. Next to each one. So salaries and wages payable. Take a minute if you want to read them, and let's do that. Okay, time's up. Let's do it. Yes. Just yes. So the first one, salaries and wages payable, is current liability. Service revenue. Yes. Service revenue will not go on the balance sheet, so it would be not applicable. This could be a tricky question. Although it is used to calculate retained earnings, this is what you talk about, right? But it's not going to show up on the balance sheet, on the classified balance sheet. So you do not put it on the balance sheet at all. Interest payable. Okay. Goodwill. Intangible assets. Short-term investments. Hence. Okay, thank you. See, there are hints in the names of that account. Mortgage payable due in 3 years. Hence. Okay, so long-term liabilities. I have to give you hints. The previous one was pretty simple and you got it all wrong. I was not happy about that. Very disappointed. But I forgive you this time. Don't do that in the exam, please. Investments in real estate. Here you're saying yes? Long-term investment. And the reason is that we said investment in real estate. We're not buying a building to use it for our own operations. Equipment. Yes. Property, plant, and equipment. Accumulated depreciation. Depreciation expense. Not applicable. Common stock. Stockholders equity. Do you include on the balance sheet? Do you include common stock or no? Yes, you do. Under common stock, so you have common stock. Underneath it, you have, you have stockholders equity. Then you have common stock and retained earnings. So you include it. This is not an investment in other companies' stocks. Common stock are the stocks of the company itself. Okay? Are the stocks of your company. Investment in stocks means when your company purchases stocks from Google or Apple. So, common stock will go under what's here? We showed. This one here. You have common stock and retained earnings. Remember, you have current assets, then etc. So you have assets, liabilities, and stockholders' equity on the balance sheet. So on every balance sheet, you have assets, liabilities, and stockholders' equity. Under stockholders' equity, you have two accounts: common stock and retained earnings. Those are the two that are included. The ones that are always excluded are revenues, expenses, and dividends. You do not include them on basically on the balance sheet. That information is included in this one here. Where were we? here. Common stock, we said stockholders equity, unearned service revenue. Sorry? Current liabilities. Although it says revenue, it's not a revenue. This is unearned revenue. This is the money that the company received in advance for services that they will earn in the future. Until they earn in the future, that money is basically they owe their clients a certain service. That's an example when the company received in advance money for the 3 billboards. They owe their clients 3 billboards. That's a liability. Okay? Any questions? Now I would like to talk a little bit about this, reversing entries, although I might not include it in the exam. Still, I would like to talk about it for 2 minutes. Now, reversing entries, again, those are, in certain cases, companies would like to make the same recurring payments in the same amount and in the same way. It will make it easier to prepare the journal entries. Do you remember the example with the, so I will jump directly to the example. But before we do that, the way it's done is by reversing the adjusting entry. Companies, they don't have to do that. This is a totally optional, and it is basically depending on the company and the way they like to prepare their books. But they don't have to do it. So I'll just give you an example. Do you remember this question here? On October 26th, this is a question about the salary. When there were 3 more days for $400 per day, as a result, the company made an adjusting entry to recognize the payment, to recognize the salaries and wages expense of $1,200. On October 22nd, the company paid $4,000. This is the bi-weekly payment. Every 2 weeks they make this payment. On October 31st, they had to adjust for the 3 more days that those employees worked, which was for the value of $1,200. Now the next payment will be on November 9th. And on November 9th, the company will be paying as check. The payment will always be $4,000. Every 2 weeks, it will be $4,000. But the journal entry will be different, because in this case, it will be $1,200 for the accrued salaries and $2,800 for the work. So those are for the work that was done in October, and those are for the ones that were done in November. Now, let's say by the end of the month, you had 4 days. So the payment now becomes $1,400 and $2,600, right? So every time, the company would have to prepare a different journal entry, right? That might be a little bit confusing. Certain companies, they prefer to make the same entry every time, which would be cash paid for salaries and wages expense. So how do you do that? This will not affect the balances at all. It's simply calling it a different thing. So the way it's done is like this. This is how we did that without reversing entries. So on October 26th, we debited salaries and wages expense $4,000. We credited cash $4,000. This is a regular payment. That's how companies like to do it, in a clean and neat way, where every time the payment for salaries would be a credit, or would be a debit to salaries and wages expense for $4,000 and a credit for the same amount to cash. Every time. Wouldn't it be easier? Rather than having every time different amount, it would be. And then we have to adjust the entry, we have to adjust for accrued salaries, right? That was the second one on October 31st. Salaries and wages expense, and salaries and wages payable, because we did not pay that money. After that, the company closed the books. So here the assumption is that we're doing that at the end of the accounting period. So the company closed the books. What does that mean? This is it. We're done. We close this one here. So we are done. When you start in the new month, you are not doing any reversing entries. So on November 9th, the company will pay still cash. The cash will always be 4,000. Okay? But the distribution of that cash will be part to pay a debt for the accrued salaries. This is salaries and wages payable. And the other part is to recognize the new expense for the 9 days that the employees work in November. Okay? For the days that those employees work in November. On the other hand, the other way will be to do it with reversing entries. So the first 3 transactions are the same. The first 3 entries are the same until the closing. In other words, the reversing entries will not affect the previous period. You are not making any changes to the previous period. This is it. We close the books. Now we started in November, right? On November 1st, what would the company do would reverse the adjusting entry. This is adjusting entry, and this is to reverse the adjusting entry, reversing the entries. We debited salaries and wages expense, 1,200, we credited. Salaries and wages payable, 1,200, that was the adjusting entry. Now we do the opposite. We debit the payable and we credit the expense. We reversed it. What would the subsequent salary entry be? On November 9th, when the company is going to make the entry to recognize the payment of salaries, it will always be salaries and wages expense, 4,000, cash, 4,000. The amounts are the same. The money that the company paid is the same. If you actually add those two together, it will be the same thing. If you combine those two, combine them, you actually end up with this one. Any questions? I know you have no questions because I said I might not ask you questions about it in the exam, right? Most likely, not just maybe. Understandable. And this is basically when we actually post them. This is what the company paid, and then you have the adjustment, and then you have also the reversing entry. It will give you the same amount eventually. Any questions? Okay. Do you have any questions about this chapter? Good. So we are on time to do that. We have time to do this. I told you before, you're never going to do that another time to me. You had me the first time. Okay, I let go, but not gonna happen. Never. If this happens, it would be shame on me. Okay, so this is actually already on your blackboard, right? I think so. It's on blackboard. Okay, and did I also post the solution? I think posted the solution, but I made it invisible. It will magically appear later on today, hopefully. I'll double check, I promise. I'll also post the sample exam, hopefully this weekend, for you guys to start preparing. Please start preparing. So this is a worksheet similar to what you will have in the exam. Okay? Once again, here to make it easier, I included these. In the exam, I will delete them. Because usually, it's not like that. Usually, you are only given balance. But because of time limitations, I cannot go through the whole thing. So let's do that. Remember, what are the steps to prepare the worksheet? The first step is to copy the information to the trial balance columns of the worksheet, right? And I did that for you. You're welcome. The second part, yes.
So we have to do that. We have to do that all the weekend.
On the exam, you will have something exactly like this. So what you will, without these ones.
Yeah.
So basically what you will have, it will be like this. This part here. And the adjustments here. And you will be asked to complete it. Yes.
The numbers in that original model.
Yeah,
Those ones?
yeah.
Yes, this is why I told you you're welcome. I did that for you guys. But you didn't even thank me. Yeah. So this is basically what you would, this is, trust me, try it at home. It's not going to take a long time, but you will be guaranteed several questions from the exam. So you have here, the first thing is to prepare the adjustment. So the first step is to copy the information to trial balance. This is already done for you guys. The next part would be to do the adjustments, to include or to basically write the adjustments. And just to clarify something, the actual worksheet will not be graded. So even if you have the whole worksheet but you do not solve it, you do not solve the or answer the questions, I cannot give you credit for it. Okay. Did I mention last time that there's an essay question in the homework that you don't need to do it? Did I? Okay, so you have in the homework. Hey, it happened. I forget. So apparently, one essay question sneaked in the assignment, and I'm not going to grade 800 essay questions. So you guys will get credit for it. It does not mean if you have already done that, you get a bonus, which is you do better in the exam. But essay questions, I'm not grading essay questions for the homework. FYI, the other class, they clapped for me when I did that, so they will get an easier version of the exam. Thank you. Now we have for the adjustments. You always start with them one by one. So the first one, A, its supplies on hand is $480. So what do you need to do? This is the ending inventory of supplies. What you need to actually look at is how much you spent. Right? So this is actually, so for this one, you look at supplies. Where's supplies? And find it. Oh, okay, here. Now, supplies. We need to debit it or credit it. So you need to decrease supplies, right? How do you decrease supplies? You credit. So we credit supplies by the amount, which is 1,250 minus 480. This is the amount that remains. So this is the amount of supplies that was used. Next to it you put A. What's the other side of the entry, of the adjusting entry? So what are the two accounts? Supplies and supplies expense. So now you need to debit supplies expense, the same amount, 770. Again, next to the reference you put A. The second one is depreciation is 720 for the quarter. As you can see here, it is for a quarter. But we don't care, it doesn't really matter. It means for the accounting period. So depreciation is 720 for the quarter. So what accounts do you include? Depreciation expense, this would be D. Is it debit or credit? Debit, right? And accumulated depreciation is credited, the same amount. This is also B. Next, interest accrued on 6 months note payable, issued January 1st is 300. Now, when is this done? March, right? How much is the interest that is accrued? They are telling you that interest that has accumulated is 300. So what's the amount that you include? They are telling you it's 300. It's 300. Now, the note is 6 months note. So this is the tricky part about those questions. Here it is interest accrued on a 6 month note payable issued January 1st. How many months did pass? 3 months. Now the interest accrued, that is the interest that has accumulated until the end of this quarter, until March 31st, is 300. They are not telling you that it's not like, for example, it's only half the time. They are not telling you that this is 300. Interest is not the 300 interest for the 6 months. This is the amount of interest that has accumulated until that day, until the day of the statement, of the worksheet. So you have to be actually careful about the wording, what they are saying. In this case, they are telling you that it is accrued. This is the accrued amount. So this is the actual accrued interest. Okay, so when we have accrued interest, what do you do? Debit interest expense. So this is C. How much do we debit it? 300. And then what do you credit? Interest payable. That's correct. Why is that? Because the company did not pay that interest. It has accumulated. Now, when will it be paid? After 6 months. So basically, after 6 months from January 1st, the amount will be paid. And at that time, the accumulated amount will be $600, not 300. Okay? But the company will have to recognize it because they are preparing the quarterly report now. Next, what do we have? Insurance expense. I'm sorry, insurance expires at the rate of $200 per month. Now this is per month, yes.
On the one before, how do we not credit not payable?
How do we not?
Why do you not credit not payable?
That's an excellent question actually. Now why don't we credit directly notes payable? The reason is that companies, they want to keep separate the principal amount. The principal is the original amount of the loan. And whatever interest has basically was incurred, whatever interest they have to pay. They want to know how much interest they are paying. It's like when you go, for example, when you use your credit cards. You want to know how much you actually purchased, but you also want to know how much you're paying interest. You don't want the whole amount to be combined. And if you look at the like, for example, credit card statements, you will see that you pay such and such interest amount, in addition to what original payments you have to pay. You bought at Macy's and at Amazon. You have those amounts specifically in the amount that you paid. And then you have, additional to that, you will have, for example, interest that you paid. You want to know, for example, maybe you're paying a lot of interest, but you're not buying a lot of stuff, but you're paying a lot of interest. So companies want to separate the original loan amount. Let's say it was a loan amount of $10,000. They want to keep track of the original amount and the interest that that is being basically accumulated or that is accrued on a monthly basis. This is why instead of just dumping everything in notes payable, they separate it between notes payable is for the principal amount, interest is for interest payable or expense is for just interest. Okay, so next we have insurance expires at the rate of $200 per month. When interest expires, what do you do? First of all, how many months do we have? 3. So the amount is supposed to be 600. Now what do we have? We know that it's going to be insurance expense, and where did we get this? Where did this expense? Yes?
Prepaid insurance.
Prepaid insurance. So we know that prepaid insurance is supposed to decrease. It's an asset. How do you decrease the asset? You credit 600, and this would be A, B, C, D. And then what do we have next? We have here insurance expense. D also, it is debited 600. The last one is services provided but unbilled. when you have services that you provided but you did not bill, those are accrued revenues. March 31st total, 1,080. Did you receive the cash? No. So this is what? When you don't receive cash, it's accounts receivable. So we know that accounts receivable will be debited because it will increase. And then you have to recognize unearned revenues. Or is it service revenues? Which one? Service revenues. So you debited, you credited 1080. It's 1080, right? And that was E. Okay? Any questions so far? Now what you need, the next step, we're done with the adjustments. The next step is to calculate the adjusted trial balance. Now when you're using Excel, it's easy because you can copy and paste the formula. Basically what you need to do is you copy this one and this one minus credits. So debits minus credits, or credits minus debits, depending on the balance of each account. Okay? So for example, for the first one, what would it be? Cash. It did not change, right? What about accounts receivable? It's 5,920 plus 1,080. Next, supplies equal to 1,250 minus 770. And as you can see, it's 480. This is the same amount that we had in the adjustment here. Next, what do we have? Bless you. Prepaid insurance. It's equal to 24. It's equal to 1,800, right? As you can see, if it does not have a letter next to it, basically it did not change. So those ones are actually the same as these ones, so we can just copy them. Okay, you're not supposed to do that, but I'm trying to save time. I know it's what? Okay. Wait. The joke is on you now. So go ahead. Happy now? Next, what do you have? You have, for example, here, we have service revenue. It's equal to 14,200 plus whatever we recognized, right? And you continue doing that. Okay? Now what do we do next? We go enjoy our weekend, right?